This is not a normal Sunday video, and I need you to treat it differently than you treat a normal Sunday video. Before Asia opens tonight, the following things are already true. 150 oil tankers and LNG vessels are anchored in open waters beyond the Strait of Hormuz. Shipping companies have paused sailings on critical routes. Oil has already jumped approximately 10% in the over-the-counter market. Analysts are projecting crude at $90 to $100 if the disruption persists. And silver enters Monday's session with COMEX registered inventory at 86 million ounces, the thinnest buffer heading into a geopolitical energy shock in recent memory. I'm not recording this video to tell you what happened. You already know what happened. US-Israel strike against Iran. Headlines everywhere. I'm recording this video on a Sunday because what matters now is not the event. It's the chain reaction, and the chain reaction has already started. You're watching the first dominoes fall in real time. The question is how many more are behind them? Today, I'm going to walk you through 5 dominoes. Each one triggers the next. Each one is verifiable. And by the end, you'll have a minute-by-minute map from Monday's Open that separates you from the 95% of participants who are going to walk into that session guided by emotion instead of mechanics. Johnny AG here. Let's go. Disclaimer. This is education, not investment advice. I don't know your position, your risk, or your timeline. What I can give you is structure, and right now, structure is the only thing standing between a plan and a panic. Domino 1, the choke point. Let me put a number on the table with a primary source so there's no ambiguity about what's at stake. According to the U.S. Energy Information Administration, flows through the Strait of Hormuz represent more than a quarter of all seaborne oil traded globally, and approximately 1/5 of total world petroleum and liquid fuels consumption. The EIA also confirms that roughly 20% of global liquefied natural gas trade passed through Hormuz in 2024, primarily from Qatar. That's the first thing you need to understand. This is not a regional conflict affecting a regional market. This is a disruption at the single most concentrated energy transit point on the planet. Every barrel of oil that passes through that strait touches freight costs, agricultural input costs, manufacturing costs, mining costs, and consumer prices in every country that imports energy, which is almost every country. Now the question everyone asks, can't they reroute? The EIA addresses this directly. Some volumes can bypass Hormuz through Saudi and UAE pipelines, with an estimated capacity of approximately 2.6 million barrels per day. But the total flow through the strait dwarfs that number. The bypass handles a fraction, the rest becomes risk premium. And risk premium in energy is the domino that knocks over everything else. Reuters reported Sunday that ships are already anchoring rather than transiting. Insurance rates are spiking. The U.S. Navy-led Joint Maritime Information Center confirmed there was no formal international communication suspending traffic, but the market is operating as if the risk is real. And in markets, perception becomes reality the moment it changes behavior. Ships stopped. Behavior changed. Domino 1 has fallen. Domino 2. Oil. When Domino 1 falls, Domino 2 falls within hours, not days, hours, because oil is the most liquid commodity market on the planet, and it reprices disruption risk in real time. Reuters reported that crude jumped approximately 10% in the over-the-counter market this weekend, moving toward $80 per barrel. A Rystad energy analyst projected a move of approximately $20 when official markets reopen, targeting something near $92. And if disruption persists beyond the initial shock, multiple analysts have modeled scenarios above 100. Now, I need you to think about what a $20 move in oil means in practical terms, not in chart terms, in economic terms. Oil is not just a commodity you put in your car. Oil is the baseline cost of civilization. It's embedded in every price. The fertilizer that grows your food was produced with natural gas. The truck that delivered your food ran on diesel. The plastic packaging around your food was derived from petroleum. The electricity that lit the warehouse where your food was stored came from a grid partially powered by gas. When oil moves $20, it doesn't create one price change. It creates a cascade of price changes across every sector of every economy simultaneously. And that cascade has a name: cost-push inflation. Not the kind of inflation created by hot demand, where people are spending too much money. The kind created by supply shock, where everything costs more to produce regardless of demand. And cost-push inflation is the kind that central banks cannot fix without breaking something. Domino 2 has already tipped in the OTC market. When official trading opens, the move gets confirmed, amplified, and transmitted into every market connected to energy, which is all of them. Domino 3. The central bank trap. This is the domino that most people skip because it requires thinking one step beyond the headline. But it's the domino that determines what happens to your purchasing power for the next 12 to 24 months. When oil spikes on a supply shock, the central bank faces a dilemma with no good answer. Path 1. Tighten monetary policy to fight the inflation. Raise rates, restrict liquidity. This slows the economy. It stresses credit markets. It increases the probability of recession. And it does all of this while the inflation it's trying to fight is coming from supply, not demand. You can't fix a supply problem by crushing demand. You just get the worst of both worlds, higher prices and a shrinking economy. That combination has a name too, stagflation. And stagflation is the environment where traditional financial assets, stocks, and bonds both lose simultaneously. The only assets that tend to perform in stagflation are real assets, commodities, energy, and metals. Path 2. Ease monetary policy to support the economy and prevent a credit crisis. Cut rates, inject liquidity. This keeps the economy functioning, but it pours fuel on the inflation fire. Every dollar of liquidity injected into a system experiencing supply-driven inflation accelerates the erosion of purchasing power. The currency buys less, savings lose value, and the market begins to price in not just the current inflation, but the expectation of future inflation. That expectation is what drives capital into gold and silver, not the fear of war, the fear of the policy response to war. And here's the part that should make you sit up. Both paths lead to the same destination for metals. Tighten, and you get recession plus stagflation, which drives safe haven demand. Ease, and you get currency debasement plus inflation expectations, which drives monetary demand. The central bank is in a room with two doors, and both doors open into the same hallway. The hallway is higher gold and silver prices. The only variable is how fast you walk down it. Reuters is already covering the recalibration of inflation and trade risk expectations. The market isn't waiting for the Fed to announce its path. The market is pricing in the fact that both paths are bullish for art assets. Domino 3 is tipping. Domino 4, gold and silver respond. Now we enter the metals market specifically, and I need to separate the two metals because they respond to this chain for different reasons and at different speeds. Gold responds to the monetary transmission. It's insurance against currency debasement, sovereign risk, and policy failure. When the central bank trap activates, gold is the first destination for capital-seeking safety outside the paper financial system. Reuters is already describing safe haven flows into gold. Analysts are modeling repricing scenarios. And there's a practical detail that most people miss. Reuters reported that physical gold flows through Dubai, one of the world's major gold trading hubs, were affected by flight cancellations related to the conflict. When war disrupts the logistics of the safe haven itself, the premium on metal that's already in your possession increases. Accessibility matters, and accessibility just got harder. Silver responds to everything gold responds to, plus an additional channel that gold doesn't have. The industrial channel. Silver is not just a monetary metal, it's a manufacturing input. And its manufacturing supply chain is sensitive to energy costs in a way that gold's is not. 70% of global silver production comes as a byproduct of base metal mining, copper, zinc, and lead. Base metal mining is energy intensive. When diesel costs $20 more per barrel, the cost of operating a truck at a copper mine increases. The cost of running a concentrator increases. The cost of smelting increases. And silver, as a byproduct, inherits all of those cost increases without any ability to independently adjust its production volume. You can't mine more silver in response to higher silver prices if the silver comes from a copper mine that's cutting production because copper doesn't justify the higher energy bill. This is why silver is the accelerant. It captures the monetary fear channel the same way gold does. And then it adds the industrial bottleneck channel on top. Two forces pulling in the same direction simultaneously. That's why silver moves faster, harder and more violently than gold during geopolitical energy shocks. It's not reckless speculation, it's structural mechanics. The metal sits at the intersection of every transmission channel this crisis activates. And the numbers underneath the mechanics are severe. 6 consecutive years of structural supply deficit, record industrial demand at 680 million ounces. The Silver Institute documenting a deficit of approximately 149 million ounces for 2024. Solar photovoltaic demand at 17% of total consumption and accelerating as TOPCon cell architecture increases silver loading per panel. Shanghai paying a persistent double-digit premium over Western markets. Chinese export controls restricting the return flow of refined silver. Those numbers existed before Friday, before the strike, before the first tanker anchored outside the strait. The Iran crisis didn't create the silver deficit. It created a scenario where the deficit gets worse because production costs are rising, supply chains are disrupted, and the monetary environment is deteriorating simultaneously. The structural thesis just got an accelerant. And an accelerant applied to a fire that's already been burning for 6 years doesn't add a spark, it adds an explosion. Domino 5. COMEX meets the shockwave. This is the domino that connects the geopolitical event to the price on your broker's screen. And it's the one where the numbers matter most. The CME's official report for February 27th shows total registered silver at 86,130,399 ounces. Registered is the metal that's sitting on the delivery counter with warrants attached, available for fulfillment against futures contracts. That number has declined over 30% in recent months, and it enters Monday's session as the buffer between an orderly market and a disorderly one. Now layer the domino chain onto that buffer. Oil spikes, inflation expectations rise, central banks are trapped, gold and silver attract capital flows, institutions and industrial users increase demand for physical metal. Shanghai's premium stays elevated or widens, pulling metal east through arbitrage. Every ounce that flows to Shanghai is one less ounce available at COMEX, and the buffer that was already at 30% depleted levels gets thinner. I am not predicting a COMEX default. I want to be absolutely clear about that. The exchange has tools, margin increases, position limits, cash settlement incentives, eligible to registered conversions. The system is designed to absorb shocks, and it will absorb this one. But absorbing a shock is not the same as absorbing a shock without consequences. When a hospital activates its emergency protocols, the patients survive, but the hospital's resources are depleted. Its capacity for the next emergency is reduced. And everyone who watched the emergency knows the hospital was tested. Confidence shifts, behavior changes. If COMEX has to raise margins, restrict positions, or incentivize cash settlement to manage the flow from this crisis, the system survives. But the market participants who watched it happen adjust their behavior going forward. They stand for delivery more often. They trust paper less. They pay Shanghai premiums instead of waiting for COMEX prices. And that behavioral shift, which is already underway, accelerates. The 5 dominoes. Chokepoint disrupted. Oil repriced. Central bank trapped. Metals activated. Thin buffer tested. Each one caused by the one before it, each one verifiable, each one already in motion before the official session opens. Now, your Monday map. 30 minutes before Asia opens. Monitor shipping headlines. Is the strait formally closed, or is it operating under extreme risk without formal closure? The distinction matters, because formal closure triggers a different level of response from governments, insurers, and exchanges. Reuters has made clear the market is already seizing up informally. Watch whether it becomes official. Asia open. Oil is the first signal. If crude opens with the projected $20 surge and holds through the first hour, the energy transmission is confirmed. Gold is the second signal. If it maintains a safe haven bid above pre-weekend levels, the monetary transmission is active. Silver is the third signal, and it's the most complex. Silver can gap up and hold, which confirms repricing. Silver can gap up and reverse, which confirms sell the news, the crowded trade unwinding. Or silver can gap up, dip on a volatility shakeout designed to flush leverage longs, and then recover. That third pattern is the most common during genuine crises with real physical tightness underneath. The shakeout tests conviction. The recovery tells you the physical bid is real. First 2 hours of global trading. Watch behavior, not price. A spike that holds is repricing. A spike that reverses is sentiment. And the tell is volume. If the spike holds on high volume, real capital is entering. If the spike reverses on low volume, the selling is mechanical, not fundamental. And here's the signal most people won't watch, but should. The East-West premium. If Shanghai opens with silver above $106 and COMEX is at $93 and that gap holds or widens through Tuesday, the physical market is confirming everything the domino chain predicted. The factories that consume silver are bidding above the exchange price, and factory floor bids during a geopolitical energy crisis are the stickiest, most durable bids in the commodity market. They don't reverse on a tweet, they reverse when metal arrives. And metal arriving through disrupted shipping lanes, with insurance rates spiking and routes rerouting around the Cape of Good Hope, takes weeks, not days. One more thing, and this might be the most important paragraph in the video. When you check your phone Monday morning and see the gap, you're going to feel something. It might be excitement if you're long, it might be fear if you're short, it might be urgency if you're on the sideline. Whatever you feel, recognize it, name it, and then don't trade it. Because the 5 dominoes I showed you are mechanical. They follow physics. Energy in, inflation out, policy response, capital flow, inventory stress. That chain operates regardless of how you feel. But your entry price, your position size, your risk management, those are decisions. And decisions made under emotional arousal are statistically the worst decisions a human being can make. The research on this is unambiguous. Emotional arousal narrows attention, increases confidence, and decreases accuracy simultaneously. You become more certain and more wrong at the same time. So, before the bell rings, write down your plan. Not after the gap, before. What price would I buy at, and in what size? What price would I sell at, and why? What scenario would make me do nothing? The plan you write in silence on Sunday night is worth more than any reaction you have in the noise of Monday morning. Because the plan was written by the version of you that can think clearly, and the reaction will be produced by the version of you that's watching a crisis unfold in real time with money on the line. The dominoes are falling, the chain is mechanical, the energy choke point has entered a zone of real risk. Oil has already responded, the central bank trap is already visible. Silver enters the week with a structural deficit, a thin delivery buffer, and a physical premium that was already telling you the paper price was too low. Now add an energy shock that raises production costs, disrupts shipping logistics, and triggers inflation expectations. Every domino pushes the next one harder. And here's the honest closing thought. I don't know how many dominoes are left. Nobody does. It depends on whether the disruption persists or resolves, whether the strait formally closes or remains in a gray zone, whether the conflict escalates or de-escalates. Those are geopolitical variables that no market analyst can predict. What I can tell you is that the dominoes that have already fallen don't unfall. The tankers that anchored don't unanchor instantly. The insurance rates that spiked don't unspike overnight. The inflation expectations that shifted don't unshift on a press release. And the silver deficit that's been accumulating for 6 years doesn't reverse because of a ceasefire. The event is new, the underlying condition is old, and the combination of a new accelerant on an old fire is what creates the moves that people remember for decades. Have a plan. Watch the chain, and let the data tell you which dominoes are still falling when the bell rings. If this briefing helped you prepare for Monday with mechanics instead of emotion, hit the like button. This video was recorded on a Sunday because the chain isn't waiting for a convenient upload schedule. Leave a comment. Gap up or shake out. Write your thesis in 2 lines. I'll be in the comments tonight because we make better decisions when we have to defend our logic out loud. Subscribe and hit the bell. I'll be covering the open in real time and posting analysis as the dominoes fall. Share this with someone who's going to check their phone Monday morning and make a decision based on a headline instead of a chain. Give them the map, not the panic. Thanks for watching. Your friend, Johnny Asian Guy.